Hello, hello. Are we live now? We know whether you guys can see and hear me okay. It failed last time, a couple seconds ago. Okay. Good to see you guys. Been a while. We have we've had last week was a crazy week. I was uh I was on a well needed vacation with my family last week, and it seems like every time I do something like that, the market goes crazy. Um so it's always like my own version of Murphy's Law. But looks like the market has been somewhat recovering here. Let's take a look at the S&P 500. We had this sell off here, um, but we've recovered back inside with the Nasdaq. Same thing. We're kind of still inside this channel here. Maybe I've got this line drawn a little bit, in the wrong spot here, just for reference. But Dow is making new all-time highs. Russell 2000 is knocking on those doors. And so we have some crazy market action, which is also kind of funny because with the overall market, the indexes are spitting distance of all-time highs, but there are many, many stocks that are down a lot, 10, 20, 30, 40%. If we take a look at some of the I guess Google's not. Google's pretty high. Amazon, like if we're taking a look at like the Mag 7, Amazon is down, let's see here, 20% from its all-time high. Let's see. Microsoft is down. This was the high right here. So Microsoft is down 25%. Meta is down. Let's see, where's the high? Right here. Down 15%. I think Nvidia is coming back up recently. What are some other big names? Netflix has just been getting clobbered still. It's down 40%. Mm, FAANG Apple's down, let's see, just a little bit, not much, just 5%. Those are just the big ones. We also have a lot of other stocks that are smaller stocks that have been some of the big growth names over the last 6 months to the last year. Those are down quite a bit more. And so, despite the fact that markets are within spitting distance of all time highs, there are many people who feel like, hey, we're in a bear market right now. Right now, I'm down 20, 30, 40% in my portfolio. So that's why there's so much elevated fear in the market right now, because there's been a lot of volatility. There's been large drawdowns in a lot of names, even though that hasn't contributed to the overall indexes being lower on average. Um, All right, guys, if you have questions for me that you want me to answer, throw them in the chat. Make sure you tag me in your comment. That way I see it. Like EJH237, you just put that in there. Perfect. You tagged me in it. So I saw it. Your vid showing the cost of being in cash. Maybe you could share some more words about how you get out of the market. How you get out of the market is too high to invest in block. I think a lot of us feel. Well, yeah. So there are a couple of things. So number one, if you are looking at like a 30-year plus time horizon, then it really doesn't matter, because there have been lost decades. Let me see if I can pull up this chart. Lost decades in the stock market before. So do I have some good? Maybe I can open all of these at the same time. Okay, let's open. Can I get all those? Okay, let's share this. So just for reference, what you're looking at here, this is it's kind of crazy, but every single one of these lines is what the stock market did for 10 years following a specific year. So I know you can't see it because it's too small for the streaming gets compressed and it's probably pretty blurry for you. But this is just the dispersion of like it's starting from any given year. It goes from 1929 through 19 shoot 1992, was that the last year on this chart? I think 92. Anyway, so it shows every single yeah, well 1992 because it's I think these are 20-year um 20-year time frames that we're looking at. And so what it allows you to see is what the normal distribution, what the normal performance is from the stock market given any year. Then here I have highlighted specific years. So I have 1928, 29, 30, 31, 1934, 1936, 1966, 1969, and 1921. I'm sorry, 1991. Um, and this highlights all of the down here. These are like the 0 years. I'm sorry, decades. And so it shows, that the market moved sideways or down for like 10 years in those specific years. So if you would have invested everything and then couldn't dollar cost average afterwards, if you would have invested everything during those years, that would have been very bad for you. Um, Here, these are just the losing decades, the lost decades. And I think there have been 11 total lost decades. Okay, and this one goes through 2024. Sorry, I've got a lot of these are just saved on my computer, by the way. So I did a project a while ago with somebody, and he helped me come up with these, and I just saved some screenshots from these. So it's taken me a second to remember what it is that we're looking at. This is zoomed in on those lost decades. And so obviously the worst one is going to be, I believe it was 1929 was the worst year. If you had invested everything and then could not dollar cost average afterwards. And then this shows the best year, the best decade, and then the worst decade. So we've got, I think 1991 was the best decade so far. And then 1929. But the reason why I'm pointing that out is because yes, there have been lost decades in the stock market before. It's not very common for any decade following any year for the last 100 years, basically. So 100 separate decades starting in 1929, then a decade starting in 1930, then a decade starting in 1931. You go on all through, today. There have been 11 decades where you would not have had a positive return after that 10 years. But that's only if you were investing everything at that top price and you could not dollar cost average afterwards. And that's just not a very realistic situation for anyone. Most people, if they were invested fully and couldn't dollar cost afterward, they didn't invest everything at the top there all in 1 year. They had been investing prior to that. So their average or overall cost would have been lower. Also, most people can still continue to invest if the stock market tanks because you decide not to retire or you decide to start working again or whatever. And so obviously there's some people who get forced into those situations, but it's very uncommon. So when I'm saying if you have a 20 or 30 or 40-year time horizon, then investing at all-time highs doesn't concern you because you're going to continue to buy as the market goes down, as you get paid and as you take some of your income and invest it. Even if there is a lost decade ahead of us, like ultimately you want something like that to happen because that allows you to buy those assets at cheaper prices before in the future those earnings and that growth happens. And so if you have a long-term time horizon, you don't need to be worried a lot about the markets and what they're doing on a day-to-day basis, even a month-to-month, quarter-to-quarter, even a year-to-year basis. Now, if you wanted to be more conservative and be able to increase, because ultimately the goal of investing is increasing or maximizing your total long-term wealth. So when you say, okay, well, I get that I don't have to be worried about it, but I wouldn't prefer to invest everything at the top because if I time it correctly, I can invest everything at the bottom and I'll have way better returns. That is absolutely true. Unfortunately, it's very difficult to time that. And so there are a couple of things that you can do in order to not increase your odds, but usually over the long term, you increase your performance this way. One of them is having an allocation to reserves or to cash. And so personally, I like about 20% in gold, 5% Bitcoin, 5% cash and cash alternatives, 30% stocks, 30% real estate, and 10% for speculation. That includes some hedging. And when you do that, it allows you to take advantage of the relative differences in performance of those different areas of your portfolio. So that when stocks are really expensive relative to gold, you're rebalancing from gold to stocks. And then or I'm sorry, I might have said that backwards. So when, this is one example of these two parts of your portfolio, but over the last 30 years, there have been times when gold has severely outperformed stocks and then times when stocks have severely outperformed gold. So rebalancing between that allows you to take advantage of that and buy low, sell high relative to each other. And the cash portion of your portfolio is a part of that. A lot of people historically in the last 30, 40 years have used bonds for the reserves portion of their portfolio. I don't like that because typically you don't get a positive real return after accounting for inflation with bonds. But if you would like to do that, it's probably, if you rebalance, you're probably going to do better than just pure stocks. If there's significant, if the correlation between them is sufficiently low. Now, for a while, the correlation has not been low. So that's another reason why I don't like bonds. But that's like, if you look at like Warren Buffett, he's got 30% in cash. It's like he's not 100% in cash. He's 30% in cash. That gives him some reserves to draw on when if assets become on sale. So hedging can be another thing if you want to do some short-term trading with a portion of your account. If you want to take 10, 20% of your portfolio and do short-term trading with it, when the extreme or when the fear greed ratio gets to extreme greed, when the VIX gets super low, when the put call ratio gets extreme, you can take advantage of those and say, hey, well, I'm just going to speculate here on a little bit of a drawdown. And the longer you do that, assuming you continue to learn from your mistakes, the better you'll get at timing those little moves. And it's not going to completely stop the losses in those small time periods, but it will help. It'll give you some dry powder to be able to deploy into those other assets that have gone down. All right, question from Wycliffe Frage. Would you address passive capital outflows from 401k withdrawals in a jobs market? Yeah, I mean, that's something that like Mike Green has done a lot of work in kind of getting this issue kind of to the forefront of people's minds. But passive investing, especially through retirement accounts, has been a driver of markets just going up kind of regardless of anything. Because people put money from their paychecks into their 401ks, and then it just automatically buys the whole market. There's no attention being paid to value. Like, is this too expensive? What are the earnings? Is this like, there's a lot less active investing. There's a lot less, a lot fewer people and a lot less money looking at intentionally trying to buy things that are good buys, and then sell things that are, too expensive or stretched. And so that's kind of like a rising tide that lifts all boats. But that dynamic can reverse when outflows exceed inflows. So over the next, I don't know exactly how long, but within years, the demographics in this country look like they're going to be shifting to where there's going to be a lot more money going out. People are going to be living off of their retirement accounts compared to the amount of money that's going in, contributions by younger people. And so that should or could have the effect of just the opposite effect, where things get indiscriminately sold regardless of value. And for the young person, that represents opportunity finally, because everything won't look so overstretched. There will finally be things that will be undervalued because a lot of money is just selling everything just because I need to take money from my 401k. So sell everything. don't care what the price is, don't care what the value is. And so that can create opportunities to buy things at very attractive valuations. Um, but of course, that can create pain in the short term. But pain, problems, opportunity, same thing. Um, let's see here. All right. Question from Live for Christ X91. Where should I invest for getting into the stock market? I do use Wealth Simple, but should I use a trading platform or is that only used for day trading? Well, um, first thing is it's up to you. So this is not my advice or recommendation for you, but just a little bit of education here. There's I would say there's going to be three kind of categories of platforms that you can look at. One of them is going to be just like automated index funds. Like you don't have to think about it when you open up the account there. They'll ask you some questions about what is your time horizon, how risky do you want to be, how aggressive do you want to be, how much money are you going to be contributing compared to your overall income and savings and all that. And they're just going to say, okay, here's like the general pie that we're going to put your money in, and it's just going to be a bunch of different index funds spread out across a bunch of different categories, a bunch of different asset classes. That's kind of like, I would say, like level one, because it requires very little knowledge about the markets, uh, allows people to just get invested very simply and very easily. That'd be like Betterment, Wealthfront, the Schwab Intelligent Portfolio, Acorns. There's others, but those are kind of those entry level, just like low low knowledge about the markets. You can start getting invested. Um, The second category would be expensive, hiring an advisor. So this is for the person who again doesn't really know much about markets, but wants to pay somebody to do that same thing for them. So if you go to like Edward Jones or even some of the places like Fidelity and Schwab offer the 1% actively managed accounts, but again, most of the time they're going to be in index funds. Um, if you go some other places, they will do individual stocks for you, and individual bonds. But again, like this is usually like registered investment advisors, like RIAs, like small firms. It's going to be expensive, 1 to 2% of your portfolio value every single year. And they're implying that they're going to be able to outperform the market. Sometimes they do, sometimes they don't. Um, the third category, I don't know if you'd call this a middle ground. We're not really operating on a spectrum here, but the third category is the more the active trading or discount broker accounts. And this is one where you just retain full control of exactly what you're invested in. So you can buy ETFs, you can sell them, you can buy mutual funds, you can sell them, you can buy individual stocks, you can do options, you can do bonds, you can keep it in cash. You go in, like you have to make all the decisions. And so this is like a regular Schwab account, Fidelity account, Vanguard, Interactive Brokers, TradeStation, Robinhood, Webull, Moomoo. I mean, you keep on going down the list. And so this is just, you put the money in and you choose exactly how it's invested. If you don't choose to invest it or what to buy, when to buy it, what price, like nothing will happen. You'll just be putting cash into an account. And when I was a broker, I saw it like it happened probably every couple of months. Somebody would like, I talked to somebody who's like, oh yeah, I've had an account here for, 10 years. What's it worth now? I'm like, well, you put 10 grand in 10 years ago. It's worth 10 grand. It's just, you didn't invest it. It's just cash. And it just, they had absolutely no idea. They thought that they were just giving money to an advisor who's investing for them. And all they did was put cash into into a brokerage account and never invested it. And so if that's kind of, you need a little bit more knowledge, a little bit more experience, a little bit more education so that you can choose how to invest appropriately. That's my preferred way to do it, because you'll be able to at least match the market. Like you can invest in index funds yourself if that's all you want to do. But you can choose individual stocks, you can do some hedging, you can do some more active stuff if you want, or you can just do the basic stuff. I like control. I don't like giving my giving my money over to somebody else to make those decisions for me. All right. Next question is from Soup and Noodle. What's your take on PayPal? They're down quite a bit, and again recently, but they seem undervalued to me. Yeah, they could be undervalued. Um, one of sometimes like there's like a filter, an easy an easy filter that I sometimes use for choosing whether or not to invest in a company. And one of those filters is, do I love the company and the product, or do I despise the company and the product? And every single time I've ever been forced to use PayPal because for some reason there's no other option, like a merchant that I'm trying to buy something from and they don't sell on Amazon, they only sell on their website, and the only payment processor that they use is PayPal. It's been the worst experience I've ever had giving somebody money, ever. I absolutely despise PayPal. They own what is it, Venmo that they own too? Is that the other one? PayPal, Venmo, or is it yeah, Venmo. I really dislike using Venmo as well. Every time I've had to use it, it's just an absolutely terrible experience. Um, I've had my card information stolen from PayPal as well. Um, and so anyway, I just really despise using the platform. So that's one filter that I use for like personally deciding like, maybe the company does look undervalued, but there might be a reason for that. Maybe it's because the only people who ever use their product are only using it because they're forced to use it. Like that nobody actually likes it and that's going to hurt their business over the long term. Now, I'm not claiming that that's actually the case with PayPal. They could be undervalued and they could be ready to explode anytime here. Um, but that can be a useful filter for um, pointing you in the direction of whether or not a company is undervalued for a good reason or for a bad reason. All right. Question from Robert the Wit. Why haven't long-term rates spiked? Is the Fed keeping them at bay secretly? No, the government is not issuing a lot of debt at the long end. So the only way for the long end to rise significantly would be for a lot of selling to happen. So selling happens from either current holders dumping or new debt being issued, because that's selling. That's literally what that is. They have an auction and they sell more debt there. And there's not a whole lot of demand at the long end, and so the U.S. government has been very careful to not overissue at the long end because they don't want to spike long rates. So they've been doing most of their borrowing at the short end, and that's where the Federal Reserve is doing buying right now. They've restarted QE. They're doing that at the short end, up to I think what is it, 3 years on their new QE program. So that's where there's a lot of liquidity, and so the federal government is rolling most of their debt over that matures into the short end because that's where there's buying taking place. Now, ultimately, the current administration wants to be able to refinance everything at the long end with low rates. And it seems like Trump thinks that if if Warsh gets in there and lowers the Fed funds rate, that will help with the long end, but it won't. That will push the long end up because now you increase inflation risk compared to growth. Uh, and so the way that they'll have to push the long end down is by doing some sort of yield curve control, QE, deregulating the banks so that the banks can go crazy on the long end. And so all of those are possibilities. And so I think that right now, if nothing happens, the long end continues to trickle up higher. Um, but with all the changes that are going to be happening at the Fed this year, I think there's a good chance that the long end actually does go down because they'll do QE through the banks and things like that. But no, the Fed is not currently keeping the long end down secretly. All right. Super chat question from 10 Curls 79. Really appreciate it. Thank you for the super chat. I'm in your course trading options and commodities. Thank you for the picks, Bloom Energy and copper mining ETF and all the others. I've sold a couple before the target. What percent gain would you consider exits early? Well, this is the kind of stuff that we cover that I can cover a lot more in detail on our private live streams inside the group. In general, I will tell you when I'm exiting. And so if something is going to happen that requires or it makes an early exit something that that I think is reasonable or prudent, then I will send out a trade alert that I'm closing early. Um, the otherwise, the profit targets that I currently have outstanding on all the open trades are, we're sitting on waiting for those profit targets to get hit. Um, and so I personally don't have any early profit targets to consider because that that's just then it's a different profit target than the one that we're currently targeting. And so if you obviously it's your trading account is up to you. So if you want to exit at an earlier profit target, that's completely up to you. You can do that whatever you want. Just keep in mind that anytime you change your overall strategy, like instead of like, let's say hypothetically, you're targeting a 100% gain on every single trade, then you also have to have a commensurate exit strategy on the losing side so that your win rate and your overall gain loss ratio lead you to have a winning overall strategy. If you lower your profit target on every trade, then you'll probably also have to tighten up your loss target on every trade. Otherwise, your profits won't be large enough to compensate you for your losses. And so, whenever you're talking about, hey, should I adjust my profit targets? That's okay, but you have to look at the other side as well. Otherwise, it'll change your overall profitability. All right. Question from Toddler Hedge Fund. When you reallocate, where do you park your gains for taxes? Um, oh man. Okay. Well, there's the right answer and there's the accurate answer. So the right answer is any money market fund. SGOV operates just like a money market fund. TBIL, BIL, all of these. You put your cash in, and then it just goes into T bills behind the scenes. I wouldn't do anything that has like corporate bonds. Um, but yeah, anything that operates like a money market fund, high yield savings account, some of these short term treasury ETFs, they're all basically cash equivalents. And most of the time I do that. However, every once in a while, it looks like there's an opportunity in the market where I will throw it into an index fund instead. And that does increase the risk that I won't have the amount that I need come tax time. But I do have it in a separate account. It's not in my my main trading account or anything. So I'm not getting tempted to throw it into options or anything like that. But the true answer is sometimes I do just throw it into an index fund because it looks like there's a good opportunity. But for the most part, I do my best to stay disciplined and keeping it in a cash in a cash vehicle, something like SGOV. Yeah. All right. Question from Chris and Christian. You've mentioned in a previous video that the Fed might remove bank limitations to buy treasuries. Wouldn't that result in treasuries go up in price, yield dropping? Yes. So you probably threw that question in before. I was talking about it already, but yes, that would be the reason why they would do it. Because if all of the banks are able to buy an basically unlimited number of treasuries, then, and they're doing that through fractional reserve banking, they don't care about the absolute yield, the absolute return they're getting on that. They care about the spread between what they're getting on that and what they have to pay. And so it opens up the doors for them to buy a massive amount of treasuries. So, and we know that that's the case because that's exactly what banks did during 2020 when the supplementary leverage ratio was temporarily suspended. They went crazy and bought a ton of treasuries. And so we know that that's what banks will do because it's like free money to them. So yes, absolutely that will happen. And that's why they will do it, to decrease the federal government's interest cost on the national debt. All right, question from Shagrit. You feel an oil event coming on, Iran situation. Yeah, I'm bullish on oil. There are a couple of picks that I've that sent out in my private trading group that are based on oil and overall energy as well. But yeah, I'm bullish on oil. I know that it doesn't look good right now, but typically when things look the worst, those sometimes present some of the best opportunities. Now, I could be wrong for sure, but I am bullish on oil, and I have a couple long positions that will benefit on oil going up. All right, question from Extraterrestrial Travels. I really want to say thank you. Your view on breakout resource alerts aligned with a certain piece of my portfolio. It's helped my account a lot. You've made some profits on my own. Well, thank you. I'm really glad to hear that. That's literally why I do it. Again, for those of you who are not part of my private program, I've been trading, successfully beating the markets on average. My return over the last 5 years is about 39%. Um, and so a couple of years ago, I just started sharing my trades with my group of subscribers in my trading group. And I have two different trade alert services. And what he's talking about is the resource breakout alerts. And that's a commodity focused one. So yeah, really glad to hear. That's why I do it, because it's helps my performance out, and want to share it with others as well. All right. I live in Canada. Where would I be saving the most fees between Wealthsimple, Questrade, or Interactive Brokers, Webull, or any others you mentioned? That's a great question. Unfortunately, I'm very focused on what happens in the US and the things that are available in the US. And I'm just not that knowledgeable about the platforms that are available for people outside the country trying to invest in US markets. I know just from what people have told me that most of the time people prefer using interactive brokers, but I don't think that's Canadians. I think typically that's people like overseas. It's people like in Australia and in Europe and other places that it's a lot hard. I think Canada. I think you have a lot easier access to U.S. markets. Um, you can look on each of their websites to look at the fees. Typically, you're not going to be paying trading commissions anywhere. Um, at least in the U.S., most platforms don't have trading commissions, and so then you're just going to be looking at like execution quality. So if you're actively trading, I think something like interactive brokers will be better because they get you order improvement on your trades, and so you place market orders instead of getting filled at the worst, the bid or the ask. Usually there's some order improvement. So if you're actively trading with large trades, that's going to be better for you. If you're just doing some, basic dollar cost averaging, then with, especially with smaller amounts, then it's not gonna make that big of a difference to you. Um, all right. Question from Maher Harsheth. I'm sorry, guys. I know that I'm probably butchering. I know these are just usernames. They're probably, most of these are not your actual names, but either way, I apologize for butchering the pronunciation if I am. How do you think we should approach taxes while rebalancing? I was using the gift loophole my country allows, but will hit gifting limits this year. Well, one way is through, well, and again, you're talking about a different country, so I don't know your tax laws, but one easy strategy that a lot of people use in the states is tax loss harvesting. Um, so what does that mean? When you take a loss on something, you sell something at a loss, you get a deduction for that against any gains that you have. When you sell something at a gain, you owe taxes on that gain. And so what some people will do, if your tax bill is large enough and your gains and your losses are significant enough, is they'll do something called tax loss harvesting, where if they sell something at a gain and they have, let's say, a $10,000 gain, they'll look for something else that they might have a loss in. Let's say you have a loss on SPY. You could sell SPY and buy instead QQQ. That will allow you to take the loss on SPY, but you'll still be invested somewhat similarly by buying QQQ, so you don't miss out on the gains afterwards. Now, maybe the performance between those two is not quite as close as you'd like. You can't just rebuy SPY because that'll trigger a wash sale. If you sell something at a loss and then rebuy it immediately, that loss just gets rolled into the cost basis of your new position. You've got a 30-day window where you can't rebuy immediately if you want to actually take the losses. So you have to buy something that is similar, but not what's called substantially identical or substantially similar. And so you want to have a little bit of a difference in the thing that you're rebuying. That way you won't get in trouble. So you can do tax loss harvesting. Um, Obviously, trading in retirement accounts or tax deferred accounts that can help. All right. Question from Eplas. Have you been keeping track of the transportation stocks this month? Companies like Old Dominion and XPO have been making huge jumps. Do you think they're overvalued? Yeah. I don't know if they're overvalued. So this is XPO. Um, XPO has a price to earnings ratio of 70, which is which is extreme. Um, what is this? The Old Dominion ODFL. This one has a PE ratio of 41, so it's better. Yeah, I mean, this is some extreme strength that we're seeing. And so obviously there's a reason for it, but that doesn't mean that there's no there's nothing irrational happening here. So I wouldn't personally, when something like this happens, this is a very strong breakout. You got a really nice breakout from a lot of consolidation that was happening in here. Um, and when you get a strong breakout like that, followed by just a massive move up, that's a very strong move. This is not something that personally would want to say, oh, that's definitely going to reverse. There's a lot of energy like a coiled spring that's been building for a very long time in here. And sellers have gotten exhausted here. Um, so now sellers are unwilling to sell at lower and lower prices, and buyers are willing to pay higher and higher prices here. And that dynamic can continue for a while, especially because of how long it was basically moving sideways and squeezing. So just because something is overvalued doesn't necessarily mean that it's not for a good reason. This could be a very good reason, could continue for a while, and earnings could absolutely catch up, which is looks like what the market is trying to. That looks like what the market consensus is saying, that earnings are going to catch up here. It's pricing in those future profits. All right. Next question from Interactive Media. Nice of you to show up now that the storm has passed. I know. I'm sorry. I said this at the beginning of the stream. Every time I, take a vacation, like in the middle of the week, like my family and I went on a week long vacation here, and we haven't done that in a long time. This might actually be the longest I was away from the markets. I still had internet, so I could still do basic work stuff a little bit, but couldn't do any live streaming or anything like that. All my videos that came out were pre-filmed. And so it wasn't like I was talking about things in my regular posted YouTube videos that were happening like immediately, like news based. And so it just seems to happen that way. Like it happened also in April of last year. I was busy doing stuff during the market crash in April. And I was like, man, this would have been perfect time to do, some up to date videos or even some live streaming. But it's like it seems to work out that way. So apologize for that. But yeah, now the storm has passed, I'm back. All right. Next question. My losses are limited due to only using ETFs and discipline. I was thinking something like transferring my shares and house to an LLC and start depreciating my house. Were you one that said that you were in a different, yeah, you're in a different country. Yeah. Again, I'm not a tax guy. I have done enough research to be dangerous and learned enough to try and minimize my own tax bill. Anytime, this is just kind of like a rule of thumb that I've learned through a lot of pain. Anytime that I have done something primarily in order to reduce my tax bill, it has resulted in me having less wealth than I would have if I would have just put taxes on the back burner and focused instead on making money. One example of that is an Airbnb. I don't know how much you guys know about real estate, but real estate can have real gains, but paper losses because of something called depreciation. Um, how much do I want to? I'll just be very basic with this. There's things you do a cost segregation study and bonus depreciation on a real estate property, and that can give you losses on paper that are greater than the income that the property produces. And so, for tax purposes, it shows up that the property has a loss, even if it has a real gain for you. If you are investing in real estate this way, the problem is that loss only applies against income from real estate. So if you have a really high earned income, like I do, my active income is extremely high. That doesn't do anything for me because it just limits the real estate losses only go against the real estate income. Doesn't do anything. I don't get any deduction for my active income. However, in the IRS code, the Internal Revenue Code, there's a specific line that says that's called the short-term loophole. It's not a loophole, it's just a carve-out. If you have a rental property where the average length of stay is 7 days or less, then the paper losses from that property can go against your active income. However, there are certain stipulations that are required to be able to meet this, and that is meeting thresholds like I can't remember the what it's exactly called, but you have to be the main one to work on the property, and you have to meet a specific minimum number of hours of work on the property in order to qualify for this. And so I marked to a T, got the logs, the Excel spreadsheets, all of that, got the number of hours, did the renovation, got everything done. It was perfect. Had those losses, be able to offset my income. And then I looked at how many hours I had to spend working on the property, looked at how much the number of dollars I saved on my taxes, and said, okay, well, what would I have made if I would have just done my normal work instead of that and like focused on just making more money? And I was way behind. I did not save anywhere near, I saved like 40 grand on my taxes, and I would have made way more than that if I would have just done my normal stuff, making more money instead. And that's happened every single time. So the overall lesson is never let the tax tail wag the investment dog. Don't put taxes first. Focus on making the most maximum amount of money first. And then number two, find ways to optimize it so that you save the most on taxes. 9 times out of 10, you will end up with far more money, far more income, far more wealth if you do that. Even if the total number of dollars that you pay in taxes is higher, you will usually end up with more dollars left in your pocket because your total income and wealth was higher at the end of that. All right. From Rahul Sampat. What's your current fundamental technical price analysis on Bitcoin? Bitcoin, that's a good one. Okay. So I don't have the charts up in front of me right now, but we can take a look at a couple of things. So number one, it looks like the bear flag here, it looks like it was completed. The price action and the selling here, for a couple of reasons, looked like coordinated selling. This does not look like, especially when you look at volume and some other things, this doesn't look like, it doesn't look like retail getting scared out. It looks like this was continuing to do what I've been talking about for a while, which is trying to get MicroStrategy to become a forced seller. If they can get the Bitcoin price down low enough with enough selling for a long enough time, then it's possible MicroStrategy then has to start selling some of their Bitcoin holdings in order to pay their obligations, like service their debt, dividends, things like that. If they can successfully do that, Bitcoin can go a lot lower. Bitcoin can go easily past 50,000, potentially even lower. The reason why they would want to do that is so that they can be the buyers at that price. If you can get MicroStrategy to become a forced seller, the price of Bitcoin goes so low and you get to scoop up a ton at a much lower price. Now, the reason personally why I'm not concerned about that is because I'm going to be one of those buyers. So the approach that I have always taken to Bitcoin ever since I became bullish on it in October of 2020, Was it 2021 or 2022? It was 10,000. When was it 10,000? Was that 20? Oh, it was back here. 20 Oh, it was 2020. Okay, it was October of 2020. That's when I read the book, the Bitcoin Standard, and when I actually decided to start learning about it, and I realized what it was and how it worked and the opportunity that was there. That's when I started a 5% allocation of my portfolio to Bitcoin, including new investments in my, my from my income, the amount that I invest. And my approach has been buy. It's an asymmetric bet. And so I'm not rebalancing from it. I'm not selling it. Um, which means as it goes down, I get to buy more of it. Now, it's possible there are definitely risks with this, which is why I call it an asymmetric bet. The likelihood is it goes to zero. Um, that's more likely, I think, than it going to a million. But with a 5% allocation, the worst case scenario for me is that I lose 5% of my portfolio. Best case scenario is it makes a huge positive impact on my overall portfolio. So that's why it looks like an asymmetric bet to me if it becomes used as universal money. So that's why I'm okay with it going down, because I get to buy more of it at a lower, cheaper price. Now, there are a couple of other things happening that look like I think that it's probably bottomed now, or at least at the bottom will probably be in between the 50, 60,000. And one of those is I think it's the Clarity Act right now. Institutions and like financial institutions and banks and maybe even the government itself. There's a lot of it looks like there's a lot of money that has still not, like, the reason why it blew up back here was expectations of something that has not happened yet from um from a regulatory standpoint. And that is still in the works. And if that goes well, then a lot of money could start flowing into Bitcoin. And so um obviously we'll see, but personally, I have not changed my opinion or my outlook on Bitcoin at all. The short term, I guess you might not want to call it fluctuations, but bear markets and bull markets, um, the skyrocketing price and then the crashes. That's something that you would expect to see for a new competing form of money that would disrupt the current financial power um, status quo. So I'm not concerned about it. But again, I do think that the more likely outcome is that it goes to zero. It is a less likely outcome that it goes to a million. But I think it's worth it. It's a good enough bet, good enough odds where I think it's worth a small allocation. All right, from Cup of Coffee. Is it a smart idea to start a daycare center business if you have the money, or is it better to just keep on investing? Hmm. Well, I don't know specifically about a daycare business. You will never have, unless you are going to be able to work your way up the ladder into positions, people, you have the skill set, the intelligence, the charisma to be able to be a C-suite executive. Or if you are committed to becoming really, really good at sales. Those are really the only two job career paths that kind of have unlimited income potential. If you want unlimited income potential outside of C-suite executive path and sales, then you're going to have to start your own business. Otherwise, you're going to be competing against people that are in jobs that have very well-defined hard caps on income. Even something like surgeons and lawyers and things like that. It's like, yeah, good income, but number one, to be able to get there, you have to spend a lot of money on the education, and that cuts into the income that you're able to keep later on once you have that income. and also it's still, even though it's good, it's still capped. You're not going to be making millions of dollars a year as a surgeon. You're going to be making a couple $100,000 a year. Um, and so personally, I think from an income perspective, it's most of the time a good idea to start a business. Now, the caveat to that is you actually have to have the skills to do that. When I quit my job as a broker and I started Heresy Financial back in 2019, I thought I had the skills. And it took me a year and a half before I was able to make enough money from my business to just pay my bills. And so it took me a long time to build the skills that I didn't know that I was missing, in order to start making money and then started making good money after that. But the reason I never started a business before that was because I didn't have any skills. So I just thought before, when I first started my career, I was like, oh, well, I want to start a business someday. I just don't know what to do. That wasn't the problem. The problem was I didn't have any skills. I didn't have anything of value to offer the world. And so I had a job to learn, and I gained those skills through my job. Um, and so I think that if you had the skills to start a daycare center, you're going to make a lot more money than working at a daycare center. Um, Now, when you say, is it better to just keep on investing? It depends. How much money are you making in your current job? How much money do you have saved? Like, if you think you're going to be able to start making good money in 6 months by starting a daycare center, I would usually triple it. You might not be able to make money for a year and a half. Can you survive that long? Um, if you think it's going to be easy, it's usually going to be 3 times as hard and take you 3 times as long and cost you 3 times as much money as you think it will. Um, so you have to do the math. You have to run the numbers and determine, okay, how long do you have? Are you making really good money right now in your current job? How much are you investing each year? How long will it take you to achieve financial freedom on your current path without changing anything? If you're 5 years away, it's like, why would maybe don't risk it right now? Maybe wait until you are financially free, and then it doesn't matter how long it takes you. If you're 40 years away from financial freedom and you think you have the skills already, maybe try starting it on the side first. Um, but the longer you have, the more time you have to recover from mistakes and mistakes in calculation about how hard it'll be. All right. Question from Alex, 4610. The January ISM rose to 52.6. Did the BBB bill have a positive effect on this data point, or more or less a coincidence? Um, I don't know. I don't know. It's it's hard to say. This is a little bit unrelated, but if you look at the Inflation Reduction Act, is that what it's called? The Inflation Reduction Act that Biden passed? Inflation Reduction Act of 2022. Passed in, let's see. Yeah, it was signed into law on August 16th of 2022. Um, when you look at the, let me show you this because I think it's just funny. Um, if you look at August of 2022, that's where the Inflation Reduction Act was passed. And so inflation did nothing but collapse from there for the next year. Now, do I think that the Inflation Reduction Act was responsible for getting the CPI to move down? No. But if you are, I don't know why I haven't seen this and I never saw it. But if I was a politician, if I was Biden, if I was somebody who worked on that, I would have been running victory laps. Like, would have never stopped talking about that. It's like one of the most tightly correlated, even though I don't think the causation is there, one of the most tightly correlated things between a bill was passed saying it was supposed to do a thing And then that exact thing happened immediately, like to an extreme amount. And again, I don't think that it was the cause. I think without the Inflation Reduction Act, um, it would have happened faster and even more. Um, it was already on its way down. However, it can be very difficult to tie connection between um, movements in the economy and bills, just because there's so much stuff that happens in them. They're not like single issue things that you can very easily track. Okay. Question from Rahul Sampat. What factors, technical signals should we? Oh, we already answered that. Okay. From Verinder Singh. Does the new Fed have significant impact on the market? Everybody's saying he's not good. No big earnings coming up this quarter. What will be the next catalyst? I think Trump will flip on Kevin. No, I think I think Kevin Warsh will flip. Um, since I made a video, I posted a video on him and all of the things that he said about reducing the balance sheet and interest rates being too low and all that. It's very interesting because there have been a couple of times when he's had different opinions, and those different opinions are usually like right before Trump is picking a Fed chair. And he just recently came out. Let me see if I could pull the article up. He just recently came out and said something about wanting to do like a yield curve control type of thing. Let me pull it up for you guys. Okay. Warsh calls for a Fed Treasury Accord, and it stirs the debate in the $30 trillion bond market. He has voiced his support for overhauling the relationship between the two institutions with a new version of an agreement that was struck in 1951. Do you guys remember what was happening between the Fed and the Treasury in 1951? It was very, very tight coordination. Yield curve control was happening at the time. And the Fed basically said, okay, our job now is to help the US government and monetize the debt, help them deleverage. From 1945-ish through about 1980, the government was able to lower its debt relative to the size of the economy, relative to GDP. Went from about 120% down to about 30%. And this is the long-term debt cycle that I've been talking about for a long time. Not just me, but plenty of others who are way smarter than me. This is something that Ray Dalio has been talking about for a long time. When you get to this point in a long-term debt cycle with the government debt to GDP ratio this high, you must have tight coordination between the central bank and the central government in order to deal with that. Otherwise, you get a deflationary death spiral. You get a debt default. You get a lot of things that the government doesn't want to have happen. So they will do what they can to be able to inflate the debt away. They cannot do that without the central bank helping them. So, despite the fact that Warsh has been very, very outspoken about the Federal Reserve contributing to inequality, been very against things like QE and keeping interest rates low, I don't think that's going to matter much once he's in office, once he's the Fed chair, assuming he is going to be a Fed chair, simply because if the Fed doesn't do that, then the government defaults. The debt must be monetized. That can happen through deregulating the banks. That can happen through expanding QE. That can happen through outright yield curve control. There are a number of ways that this could happen, but it has to happen from their perspective. So it's going to. I mean, that's literally the Federal Reserve's mandate given to them by Congress is stable prices, maximum employment, and moderate long-term interest rates. And the sentence that comes before that in the Federal Reserve Amendment of 1977, the intro sentence is that the Federal Reserve must increase the aggregate. Basically, in plain English, it's the Federal Reserve must expand the money supply in pace with the growth in the economy. Um, it's so that the government doesn't default. That's the reason why they exist today. Maybe not why they started, but that's why they exist today. Um, all right. Question from Pizza Made Madoit. I'm 54, have about 10 years to go before retirement. I'm currently saving $2,000 a month in 13-week treasuries, waiting for a nice pullback in the S&P to deploy. Dumb? I don't know if it's dumb. I would, look at what is the percentage that you're looking at here. Are you 95% invested right now and all of your new money you're just storing up in cash waiting for a pullback? Then overall your allocation is not extreme. Um, but if you're saying, okay, well, I've got 50% in cash right now because I've been doing this for a while, and I also sold for a while, then I would ask, what did you do during April of 2025? Because if you didn't buy in April of 2025, then you don't know what a crash is. If you don't know what a crash is, you won't buy it when it happens, which means all of your cash savings are doing nothing but burning up from inflation. Um, and so you have to be able to be realistic with yourself about how you are able to operate in the face of fear in the markets, um, with your level of experience and judgment about what is happening in the market. Are you able to rationally assess, hey, the market is down 25%. That's a reasonable bear market. I think I'm going to deploy some cash here. Now, if you've always been fully invested and you never really had that opportunity, you've just been dollar cost averaging from your paychecks the entire way, then maybe you don't have that experience to look back on. Um, but those are some things that you need to be realistic with yourself about. Like, what is the point? Like, can you answer the question, what would cause you to buy? Are you looking for a 5%, 10%, 20%, 25%? When it happens, are you going to be fearful that it's going to go down another 25 or 50% from there? And is it going to cause you to, like, do you have some limit orders that are placed already, waiting to buy immediately so that your strategy gets executed without your emotion influencing it in the moment? Are you selling cash secured equity puts so that you're getting paid along the way with that cash? And then if it does drop, then you get to buy at the prices that you wanted to buy anyway. What are the things that you are doing right now? What are the things that will cause you to change your current behavior? Those are all very important. So I would say if you are over a 30% allocation in cash, then you are more conservative than Warren Buffett, who is one of the most conservative investors. Um, and so those are all things to consider. I can't answer that question for you, but those are things that you need to be able to answer for yourself. All right. Okay. Guys, don't put the same question in twice. I will get to the question. I'm just going through them one by one. So if you already put a question in, don't put it in again. Um, all right. Interactive media. I'm betting big on EVTOL as a new transformative technology, especially as it synergizes with AI. What do you think about it? Are you into aviation? Do you have a preferred industry? Um, yeah, this one is hard for me. So just so you guys know, whenever I tell you when I have a position, I'm long, I'm short, whatever. It's just so you guys know my bias. Whether my opinion is strong enough to have a position. Because if I don't have a position, it means my opinion on it is not strong enough to have a position. So that's why I'm letting you know. I currently do not have any positions in any aviation at all. I might have let me just double check. I might have a very small position in my robotics and automation portfolio. Um, but I definitely don't have concentration at all. I don't have any significant positions. Portfolio holdings. Let's see. No, no, no. Okay. So if there are any aviation stocks in the ETF ROBO, or BOTZ, BOTZ, or ROBT, then I might have a little bit of exposure, but I don't have any intentional exposure to any of these. Part of the reason it's hard is because they're very it's such a tightly regulated space. Oh, I do have an aviation position. It's a company called Boom Supersonic. It's a private company. It's not public yet, but they have a patent on a design that allows this that causes the what's it called, the sonic boom to travel upwards only instead of down. And so right now, supersonic travel is illegal because the supersonic boom, the sonic boom is too loud, so it was outlawed. But this company can make planes that the sonic boom only travels upwards, so it eliminates the need for that law. So they're trying to get the law changed. I can't remember if it's changed already. Anyway, they're trying to get it passed, and it looks like they've got good progress there. But in terms of like AI automated, like little flying cars or anything like that, I don't have any. Part of the reason why is because it's a very heavily regulated. It's hard to have innovation in a space that like laws basically prevent anything new from happening. Um, the in terms of like regular everyday people traveling, I don't think it's ever going to happen. You're never going to have people that have like, flying cars instead of cars, because you need displacement of mass in order to counteract gravity. And that can either happen through combustion, like with rockets, which are loud and expensive, and you're not going to have that in your backyard, or it can happen through moving air, which, because of the mass displacement, it's extremely loud, and there's no way around that. And so you're not going to want somebody with a flying car any more than you want your neighbor to have a helicopter. So they can make it maybe a little bit quieter through things like changing the wing designs so that the sound waves are disrupted against each other, kind of like the noise canceling headphones, just not as powerful. But it's not going to be something that, like, it's not going to be like a car. So maybe in like 50 or 100 years, but I don't think it's anywhere close. So anyway, it's hard to invest in that space for me because it's heavily regulated. It's hard to innovate, hard to get stuff passed, and I don't think it's going to be something that can be deployed at scale, unless I'm just completely wrong about the physics, which could be true. All right. Since I last chatted on here, I got my first client where I have to train their fresher employees. Unis here in India teach stuff from the 1950s. Competition in the field I do is low. Okay. All right. Could you comment on Duolingo stock? Its current price of 115 to 120 per share. Okay. Duolingo. Duolingo had a nice bull run from the bottom after its IPO up to its top of 752%. Nice little run. And now it has lost almost all of that. It's down 78%. Interestingly, just so you guys, this is a little side note, if it falls 88%, it will have retraced its entire 750% run. Let me reiterate. It went up 750% from the bottom. And if it only falls 88%, it will have given up all of those gains. So an 88% loss equals a 750% gain. Now I'm rounding; those are rough numbers, but they're not exact. Gains or losses are a lot more powerful than gains. This is why every single one of all of the best traders and investors throughout history have the same number one rule, which is manage your risk. Make sure no matter what, you eliminate the chance of a large drawdown. If that's the only thing you ever learn how to do in investing, that will put you ahead of 95% of people who try to make money in the markets in terms of performance. If the only thing you do is take care of your losses, then your profits will take care of you. Because losses are exponentially more powerful than gains. Duolingo has fallen. This is a company that I never took a position in. And I still don't. They have, I would say, they have good branding. They have a good brand. It just seems like the need for their product is probably gone. And I could be wrong about that, but to me, a fall like this feels justified because in a world with AI, even if it never gets any better, which it probably will still get a lot better for a very long time, even if it never gets any better from here, you can communicate with anybody in the world using an AI translator. You can learn any language in the world using AI as your teacher. And so it essentially took something that was a this is what technology does. Technology takes something that was costly, that was difficult, um, that required a lot of time and labor and service and overall cost, and it takes it and makes it cheap or free. Um, that's what the internet revolution, the information revolution did to information and knowledge. Like anybody can learn anything they want for free today, whereas that didn't exist 50 years ago, 60 years ago, or for all of human history. If you wanted to learn something, you had to go somehow find somebody who already knew that thing and convince them to teach you. And that's just not the case anymore. So that's what technology does. It gets you more for less. Takes something that was costly, makes it abundant and cheap. Um, and so to me, a fall like that in a company that teaches you how to learn languages seems justified to me because why do you need Duolingo now if you've got ChatGPT or Grok or Gemini or any of the others? All right. Next question. Is China really selling US treasuries now? If so, won't this strengthen their currency? And will this make gold go up? They're not dumping. They might be slowly selling, but they're not dumping. But this is one of the reasons why long-term treasuries don't have a lot of demand right now because there's just not a lot of money buying. This is why I think the Fed is going to have to do something, whether it's yield curve control or deregulating the banks, something else. Over the long term, yes, I am very bullish on gold. I think that there's a good chance that it's probably topped out for a while here, but it doesn't mean that I'm definitely not selling. So I'm bullish on gold. All right, question from Sparks. What are your views on the AI ecosystem and the large amounts of invested money involved? Is it a bubble? Well, everywhere you look right now, it looks like a bubble. Real estate looks like a bubble. Stocks look like a bubble. Energy stocks look like a bubble. Commodity stocks look like a bubble. AI stocks look like a bubble. When everything is a bubble, really what's happening is your denominator is changing. You're just seeing a collapse in the value of the denominator, what you're using to price it in. So it's just dollar debasement that you're seeing. You're not seeing a bubble because bubbles are isolated. Like when the .com bubble happened, it was internet stocks. It wasn't everything. When the housing bubble happened, it was single family homes. It wasn't everything. So whenever you like look around and see a bubble everywhere you look, it's kind of like the Incredibles quote. If everyone is super, then nobody is. If everything's a bubble, maybe nothing is. Maybe we're just measuring it the wrong way, which means that maybe there's justification. Maybe there's a reason why all this money is running into these assets that look expensive because they're protecting themselves from the loss of purchasing power that they'd have by just holding the money. Now specifically with AI, I personally, and I could be wrong about this, I personally don't think it's a bubble. There's a lot of money that's being like you never saw Google and Amazon start spending billions or tens of billions or hundreds of billions of dollars on NFTs or launching their own crypto coins or and part of the reason why is because it's like, well, the economics were pretty clear that it wasn't there. There was something speculative that couldn't produce cash flow, couldn't produce profits. So big money never participated. Oftentimes when there are bubbles, it's largely driven by retail speculation. Now it doesn't mean that like big players can't get taken down because they enable it, like the banks were enabling speculation in the housing market. And so because they were threatened by the collapse, they got the bailout. But it doesn't, like when you see these large companies committing to spend so much, like they very much believe that there's going to be a positive return on that invested capital, um, and that by not doing so, they're going to be left in the dust. And I think that's a pretty good indication that um, we're on the you know the we're in the early innings of a large growth of a new technology that will provide huge wealth gains across the economy in ways that most people can't anticipate because it's going to be new. It's not redoing something that's happening right now. Um, so it doesn't look like a bubble to me. That doesn't mean it can't turn into one for sure, but it doesn't look like a bubble to me. All right. What is the most effective way to learn basic technical analysis using the 80-20 rule if the goal is long-term buys for blue chips indexes during bear markets? Not interested in trading. Um, if the goal is long-term buys for blue chips, then I mean, maybe watch a couple YouTube videos on the most basic technical analysis things that there are. I've got a course. It's my hedged hypergrowth portfolio. Um, I think it's $99. And I've got a section in there on the basics of technical analysis, just the like the 80-20 or probably even like the 90-10. Um, so I'll throw that in the chat here. Um, that's that's like the 80-20, but again, you can just watch a couple YouTube videos on the basic stuff. And I'm talking about like simple moving averages, support and resistance, trend lines, um, some basic patterns like wedges, rectangles, head and shoulders, just the absolute basic stuff. How to interpret volume. Um, you're not if you're just trying to invest for the long term, you're not gonna need anything that's not the main most commonly used most basic stuff. So and to be honest, long term blue like you really don't even need that. D- Dollar cost averaging will probably be enough, but you want a little bit of an edge. Looking at buying something off of the 200 simple moving average, um, setting some appropriate stops, just the basic stuff. You can get it on YouTube or you can get it from my course. All right. So okay. If you guys tag me, I would like to see a question. So this is, if I, if you tag me, have a question in there for me. That way I know that it's a question for me. Um, and if you have a question for me, make sure you do tag me. Are mining stocks a trap right now, or about to rocket? It depends on which mining stocks you're talking about. I think like the precious metal um, mining stocks, it seems like the market is pricing in a retracement in the price of precious metals. Um, and the market could be wrong about that, but that's what it looks like. Whereas like other mining stocks that deal in like more base metals, industrial metals, I'm a lot more bullish on right now. Any companies you're interested in as the electrical grid begins to get revamped in the next few years? Yeah, there's quite a few. I think this is the thing that people are always looking for is the shovels and the pick sellers. I think everybody for some reason this was like in every history book in every history class when people were growing up was like everybody went to go for the gold rush to go try and find gold, but the people who got rich were the ones selling the picks and the shovels. And that's like the thing that people look for so much today that they overlook the actual gold, like metaphorically speaking. Um, but I think that the like utility stocks, grid stocks, companies um, that produce the things necessary to deliver energy, um, those are positioned very well. A lot of them are very attractively valued. There's going to be demand for years, if not decades. Like our entire grid is so overdue. And the demand for energy and electricity is just skyrocketing. Um, and so most of these companies, I think, are positioned very well. What's up, Ninja? I think I missed you. But yeah, figuring out the tanning thing. It's the lighting, man. All you got to do is adjust the lighting in your videos. Maybe it's because you have an Android. Maybe that's the issue. Maybe someday you'll be rich enough to be able to afford an iPhone. All right. Next question. When the media refers to a certain individual as Orange Man, I just presume they're referring to heresy at this point. Man, do I really look that orange? It doesn't look that way on screen to me. Here, let me. How's that? Do I look less orange now? I just changed my light color to be more white instead of cool instead of warm. Um, I did just go on vacation though, so that is one of the reasons. I'm actually I did spend a lot of time out in the sun over the last week. So, what about the contention that AI data centers will be powered in large part by natural gas? If so, what about those who stream it? Yes, I mean there's not enough power. There's not enough that like the grid cannot supply what a lot of these data centers need. And so there are any company that is able to deliver on-site power generation is also positioned to do very, very well. In fact, that might be a trend that just continues into the future. That's like, okay, we realize the government is not competent enough to deliver the energy needs that we need for the future. And so we're just going to build our own power on site and not worry about the grid, not be connected in. Um, and that is a trend that I think at least partly will continue. Decentralized power generation is taking off like crazy. There are companies like I'm Long Bloom Energy. They have the natural gas generators that they set up on site for data centers and hospitals and things like that. I think companies are going to be leaning very heavily on solutions like that until the grid can catch up or until they can get nuclear power plants built for themselves. Like if there's enough deregulation in nuclear, then we're like, okay, we're 5 to 10 years away from building a nuclear power plant on site, so we're going to use diesel and natural gas generators on site in the meantime until we get to that, which is going to have a much greater long term payoff. All right, question from Juan, and we've been going for a while now, so this is going to be the last one. Will the pullback? Oh, there's a super chat. Okay, I'll get that one too. Will the Japan bond situation lead to a short-term pullback in U.S. equities? Could. I don't think it'll be anything significant. I think that we've probably already seen that happen quite a bit. But I think it could. Any volatility that happens from stuff like that, to me, I look at that as like, hey, this is maybe an opportunity to trade around it a little bit, but it's not going to be something that has the ability to turn a bull market into a bear market. We might see volatility. I mean, from that, but other things as well. I expect an increase in volatility or a continuation of flash crashes and things like that. In all seriousness, keep up the awesome content. All right. Yeah, no, I knew you guys were messing with me about the about looking orange. But I did. So this is I try and get a lot of sunlight. This is just, some like for vitamin D and things like that. And for a while I was like, I drink my coffee outside in the sunlight every single morning and I would face directly at the sun. And what I noticed was after a while, like if I turn my head, like the sides of my head would be a lot more white than like than the front. And then my editor on the color grading for my videos was had gotten a little bit too warm. Mainly it was my fault because I had the white balance set on my camera different than I had the white balance set on my lights. And so I started getting a bunch of comments. People were saying that it looked like I was wearing orange makeup in my YouTube videos and saying that I missed the orange makeup on the side of my head. And so I started treating myself like a rotisserie chicken a little bit. So I'll turn in the sun instead of just facing directly at it. And then I fixed the color grading too. But um, it's like a common, it's like a recurring problem of mine that I continue to look too orange in my videos. So um, I always have to watch out for that. All right. Thanks so much for all the great questions, guys. I've got a lot of work to catch up on from being gone for the last week. Glad to be back, and we'll see you guys next time.